Hello and good morning. I'm Ethan Feller from Zacks Investment Research, and this is Momentum Mondays. As usual, we're going to go over the happenings of the market for this week, do a little summary about last week, and then I'm going to share a few technical trading setups in stocks with top Zacks ranks. There's a lot to cover, what's going on this week, so let's get into it. So it was a busy and kind of ugly week last week in the markets. So let's do a little bit of review, what happened in the indexes. We can see that there's been some real technical breakdowns in the market. And let's actually take a look at the NASDAQ, which we've been using as our broad leader. And we can see this really important level of support has now been broken. We noted that on Monday, we were holding this level. You got a little gap up and a bounce off of it, which I thought was encouraging. But there was just a flush through the end of the week. So what happened? What's causing this? It seems like escalations of what's going on in the Middle East is weighing on markets, continuing to stress investors out. And also, interest rates continue to hold up near their highs. We can see the 10-year is sort of actually building out a flag just below 5%, and is building a consolidation between 4.8% and 5%, kind of looking like one of our momentum setups. So we'll see. I mean, maybe we get another breakout above 5, or hopefully, it breaks down below 4.8. But this is a continuing development here. So just looking over everything we got to look at today. So it is stretched here on the downside. There are some negative developments going on, but the market is pretty oversold here, and I wouldn't be surprised if we got at least a technical bounce this week to some higher levels. So a couple things I want to look at. Here we have the National Association of Active Investment Managers. This is a survey, and it shows how much exposure active money managers have in the market to stocks. So right here is what we're looking at. We can see that exposure to equities is the lowest that it's been in 2023. And it's nearing these lows of 2022, which marked a low in the markets. I think this is useful as sort of a contrary indicator, and I think investors are clearly scared and they've degrossed and they're not holding a lot of stocks. And when the index gets this low, it often marks near lows in the equities market. So investors are scared, and you want to start looking to pick up stocks when things look ugly. Now, it's never straightforward. We never know exactly what's going to happen in the markets. But, it's reasonable to be cautious. We see markets rolling over. We see these technical levels being broken. But you don't want to play into the fear too far. And this certainly isn't a market that is wildly overvalued. The S&P 500's forward earnings multiple is under 20. So it's not a bad time to start looking for stocks that you think that you like. Something else I want to look at is, so to play sort of in the bullish side, we got the survey index. The investor survey index is showing investors are underweight equities. And I also want to take a quick look at this seasonality chart. Shows, so we can see here's October. Typically, stocks bottom looks like about the first week in October. So we've diverted from that a little bit. So you would expect October to finish a little bit stronger, but so far we've stayed weak. However, the rest of the year is typically quite bullish. So, we'll see if these seasonality factors come into play and start to be a little bit more bullish. Another thing I want to look at is here we got Okay, I'm going to quickly. So we talked about interest rates. The 10-year is really high. And so what I want to look at is we got yield curve inversions. So it's a popular topic. When yield curves invert, it typically doesn't. Yield curves inversions typically happen before a recession. So, but what's interesting is what a lot of people don't talk about is yield curve inversions typically indicate that a recession might be coming. But what really is worth watching is when the yield curve uninverts. So we see yield curve. So here we have, this is the current period right here. So the yield curve, the 10-year treasury yield is below the 2-year, which is atypical. So we see here, right, an inversion preceded a recession, inversion preceded a recession, inversion preceded a recession. But what's important to note is that it was when it uninverted was when when it signaled that a recession was coming soon. You see yield curve inverted, and it uninverted. Recession followed soon after. Inverted, and then it uninverted. So we're getting closer to an uninversion, to the yield curve going back into a normal curve. So it's an important development to watch. And so this is the 10-2s curve, and this is the 10-year 3-month curve, which tends to be a little bit less noisy, and I think is actually the one that should be watched closer. So we're getting close to the uninversion, and when it does uninvert, it might mean we're getting closer to a recession. So that could also be what's weighing on stocks, is that investors are starting to anticipate a recession coming. Ironically, last week, we got some really good data regarding economic growth. GDP came in above estimates at 4.9% annual growth, which is a really nice growth rate for the U.S. economy. Right here we can see estimates were 4.7, and we came in at 4.9%. And last quarter annual GDP growth was estimated at 2.1%. However, something else we've been watching is initial jobless claims. And we said we've been waiting for initial jobless claims to tick up. Kept being below estimates, and we finally got a tick higher. So estimates were for 207,000 initial jobless claims. It came in at 210,000. So initial jobless claims are starting to pick up, and that's, 210,000 is still a pretty low number. But if that number begins to get higher and accelerates higher, maybe we'll get a recession. Maybe it's quarter 1, 2024. So while we're here, let's take a look at the calendar. What's going on this week? Monday is a light day. Tuesday, consumer confidence. Wednesday is a big day. So we got the Federal Reserve has their interest rate policy meeting. FOMC, Jerome Powell, he's going to do answer some questions, and we'll see. That'll play into the interest rate picture. We'll get back to that in a second. Let's just take a look at the rest of the things. So we got more labor data with ADP employment, job openings. Also got ISM manufacturing. Thursday, initial jobless claims. Again, we want to take a look at this number really closely. The estimates are going to be for 215,000, and last week we had 210,000. So let's see if this continues to suppress the upside. And then more labor market data on Friday with non-farm payroll, unemployment rate, wages, and so that'll be important to watch. So jumping back to the Fed, we have our Fed Watch tool, which takes a look at the federal funds futures markets to estimate what market expectations are for Federal Reserve's policy, interest rate policy. So we can see there's a 98.6% chance that the Fed leaves interest rates unchanged, which makes sense because interest rates are tight and inflation is beginning to slow. So investors are expecting no interest rate hikes. And we can see that the expectations are, so this is taking a look at future meetings and what the expectations are. We can see that the markets are pricing in interest rates to be unchanged through June 2024. Those are the most likely scenario. This can change daily, though. And the estimates are for rates to begin to see cuts in June. And they're expecting 1, 2, 3 cuts by the end of 2024. So something else that some policymakers have noted is that these very high interest rates with treasury yields rallying so significantly that this has also tightened markets, and it makes their job a little bit easier. They don't have to raise rates anymore, and the market is pricing in these higher rates, which should slow the economy down a bit. Another really important economic event this week that isn't actually on the calendar is the quarterly refunding announcement by the U.S. Treasury. It's not something that's often talked about, but the U.S. Treasury, they pay for the U.S. government's expenses. And part of what has caused interest rates to rally so significantly is that because the U.S. government is running in such a deficit, right? There's a lot of spending going on from the government since COVID, and this year we have a very high deficit. To do that, the Treasury has to issue debt. The Treasury has to sell treasuries to the market and to fund the government expenses. So there's a lot of selling. There's a lot of Treasury selling, and that's what causes interest rates to go up. As bond prices go down, interest rates go higher, and that's been put a lot of pressure on the Treasury market. And so the Treasury issues these regular announcements about how much debt they're going to be issuing into the market. So it's going to be important. Markets are going to be watching closely, right? Everyone pretty much knows what the Fed is going to do. The expectations are 99% chance they're not going to change rates. This meeting is also happening Wednesday, so market participants are going to be watching this closely. How much more debt is the Treasury going to have to issue? And so, if it's a big number, if they're going to have to issue more debt than expected, that's going to put further pressure on interest rates, and it's going to probably make us pop above 5%. But if the Treasury announces that they're going to maybe issue a little bit less debt, then, that maybe ease some pressure off treasuries, and it would be a positive development for the market. If interest rates go lower, that would be good for equities. So next thing we want to look at, another interesting development was gold has been extremely strong. We noted this kind of big flag pattern here. We broke out, and last week gold closed above 2,000, which is a pretty significant development. This candle here on Friday shows a reversal, but this is a misprint. Gold finished Tuesday above 2,000. Finished on Friday above 2,000. Finished the week above 2,000, and that has to do with the volatility abroad, and people are looking to gold as a flight to safety. So with all this, all right, we took a look at everything. We looked at broad markets, what happened last week. It's on the economic calendar. What else is happening this week? We've got earnings. There's a lot of earnings this week. This is a major week for earnings. So this morning, McDonald's reported earnings. Looks like they beat. It's also a lighter day on Monday. Tuesday, we got Pfizer, AMD, Amgen, Caterpillar, BP, Anheuser-Busch. Then on Wednesday, a couple of big Chinese companies, Qualcomm, Mondelez, CVS, and Airbnb. On Thursday, very big day, we got Apple. Apple, obviously the biggest public company in the world, iPhone producer. It's going to be really important to see how Apple performed this quarter. People are going to be watching that very closely. iPhone sales, of course, are going to be critical. Their new services business, quickly growing business, we'll see how that does. Then we also have Eli Lilly and Novo Nordisk, Shell, ConocoPhillips, S&P Global, Starbucks. And then on Friday, let's see what's going on. Friday we got Berkshire Hathaway, and it'll always be interesting to hear what Warren Buffett and Charlie Munger have to say. Okay, so let's get into the technical trade setups finally. I know there's a lot to cover. It's a really busy week. A lot is happening, so there's a lot of things in the market to stay abreast of. So the first stock we're going to look at is Constellation Energy Group. This is a utility company. They do natural gas, and they have quickly growing alternative energy segment as well. It's got really high earnings per share growth forecasted. It's got a reasonable earnings multiple at 20. It's got a little dividend at 1%. And of course, it has a top Zacks rank indicating upward trending earnings revisions. So let's take a look at this up. So we got a little bull flag here. It's also worth noting that the utility sector has been pretty much bombed out this year, performed very poorly. We had a huge sell-off earlier in the month, and you can see it's down 30% from the highs. And so I like, especially when you're trading momentum stocks, it's great to find stocks that are showing relative strength. And this has shown incredible relative strength against the utilities sector and against the market. It's only sold off a little bit while the market sold off considerably, almost 10%, over 10% actually. So yeah, we got this nice little bull flag here. The market is now opened, and we're seeing it's actually breaking above this level that I marked here. If Constellation Energy can close today above 113 or 112.75, we'll call it, I think that would be a nice signal as a breakout trade. Alternatively, if you see it reverse back below this level, like it did here, and trade below about 110, I think then this technical setup would be invalidated, and you may want to look for other trades. The next one we're going to look at is Dell Technologies. It's a stock that we've highlighted a few times here, and I'll show you a setup in a second. Top Zacks rank. Got strong earnings revisions trend. Good style scores too. As we've noted before, it's got a very reasonable 10 times forward earnings multiple, good earnings per share growth estimates, and Dell is a good stock. They make good products, and so yeah, we've been noticing this. We've been noting this really nice bull flag building for nearly 2 months. And again, it's shown really nice relative strength against the market. It's held up very well. You got a nice margin of safety with that very low earnings multiple. And you got this technical setup now. So again, this morning, it looks like Dell wants to push above this level here at about, let's say 66.25 or 66.30. So if we close above here, we break out above this level. I think this one's good for a nice rally as well. And again, for all of these setups, how the market acts is going to be a major factor. If we can get a nice relief bounce, or if we can put in a low, these stocks will really get going because they're all showing relative strength, and investors will pile into these leaders. So yeah, above 66.50, this looks like a good stock to trade. A reversal, not ideal. And, if it trades below there and then gets below about 64, again, this setup is invalid, and we're going to want to look for other setups. The next stock we're going to look at is AppLovin, another technology stock. It's got, it's for advertising technology. It is, again, a Zacks rank 1 stock, nice earnings growth. Bit of a higher earnings multiple, but this is a fast-growing stock. And it's been one of the leaders this year. this too, it shows some pretty good relative strength. It's building out this bull flag here. This is like a pretty typical cup and handle pattern. However, I guess it looks like this morning in trading, though, it's sort of breaking below this level, but we'll see. You can see on Thursday, we broke below this level of support, but made a nice reversal. These kind of reversal candles I like to look for. That means, okay, we sold off, but investors dove back into the stock, bought it up, and it closed right near where it opened. And that's strong. That's a bullish indicator for me. So we'll see. It's got to hold this 36 level, and then we're going to want to see it break above 38 to indicate a breakout. So that's another stock to keep an eye on. And the last one is McKesson. This is a healthcare company. They got a pharmaceutical side, and they got a technology side, software. I kind of broke these up. We got McKesson, which is a slightly more defensive name in healthcare, and Constellation. Constellation Energy. And these two are a little bit more defensive. So we got stocks that'll maybe perform a little bit better if the market doesn't do well. And then we got Dell and App, which are tech stocks, which if the market does decide to play ball and rally a little bit, those should do better. McKesson, like the others, it's Zacks rank 1. Good earnings growth, reasonable 10% earnings growth is forecasted, and forward PE of 16.5, which are quite reasonable. And it too is building out a nice little bull flag here, very tight setup. So if we get a breakout above 450, again, that'll indicate that we might see some higher prices. Alternatively, below, let's say 444 or 445, you might want to avoid it and wait for another setup. And that's it for the technical trades. If you like this content, please subscribe to the Zacks YouTube channel. And if you want more information from Zacks, I definitely recommend signing up for our promotion. You can click the link in the description below. Have a good day.